Have you ever wondered what happens when the biggest players on Wall Street run out of money, while a company everyone counted out starts stacking wins? That's exactly what's happening right now with AMC. The box office is booming, the debt situation is improving, and shorts, the same ones who've been betting against AMC for years, are staring down the barrel of margin calls. Today, we're breaking down why AMC is in one of the strongest positions we've seen in years, how it's making more money, and why short sellers are in serious trouble. Stick around, because once you understand the full picture, you'll see why the game has completely changed. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads, and also enter our giveaway. But everyone remember, this is not a financial advice video. AMC has been a company people love to talk about. For years, the narrative has swung back and forth, some calling it doomed, others calling it the play of a lifetime. But when you strip away the noise and just look at the numbers, the strategy, and the broader market conditions, a very clear story is emerging. AMC is bringing in more money than ever, becoming financially stronger, and setting itself up to fight back against short sellers who are rapidly running out of options. Let's start with AMC's revenue story. The most obvious driver is the box office, and right now ticket sales are showing serious momentum. According to data floating around, AMC is set to break past $2 billion in box office revenue after this week, with projections to hit around $2.1 billion shortly after. That's a massive sign of recovery. It's not just about individual movie releases, it's about a broader trend. People are going back to theaters, blockbuster films are filling seats, and AMC has refined its operations to squeeze out more profit per ticket than in the past. But the box office is only part of the puzzle. AMC has been making smart moves in cutting costs and streamlining its business. Think of it this way. Every dollar saved is essentially another dollar earned. And with the way management has restructured operations, AMC is in a much stronger position to keep profits flowing consistently, even during slower movie months. Now, here's where things get even more interesting. A recent report noted that Morgan Stanley is now expecting 4 straight interest rate cuts in 2025. That might sound like just another headline in financial news, but for AMC, it's a huge deal. Why? Because every time interest rates go down, AMC saves millions on debt payments. Right now, projections suggest AMC could save around $4.5 million per quarter thanks to these potential cuts. That's not pocket change. It's money that can be redirected toward reducing debt even further, improving earnings, or reinvesting in future growth opportunities. And remember, AMC isn't just about theaters. They've made strategic investments, like in HYMC, that have started to pay off, diversifying their income streams. Every layer of revenue and savings builds a stronger foundation, and as that foundation grows, the fundamentals look better on paper. Stronger fundamentals attract more capital, make bankruptcy fears fade into the background, and even open the door for things like dividends in the future, something that would put even more pressure on shorts. So on the one hand, AMC is moving into a position of strength. On the other hand, shorts are dealing with the exact opposite reality. Let's talk about liquidity. One of the most important metrics to watch is the reverse repo market. Not long ago, reverse repo balances were sitting at around $2 trillion. That was a massive pool of easy liquidity that hedge funds and institutions could tap into for their short strategies. But today, that number has collapsed down to just $17 billion. That's right, from trillions to billions in just a couple of years. What does that mean? It means short sellers no longer have the same easy access to money they once did. Liquidity has dried up. And without that cash, it becomes much harder to keep borrowing shares, rolling over positions, or creating synthetic pressure against AMC. This explains why we're seeing panic in the short community, more FUD campaigns, more attempts to push negative narratives, and even some short players flipping long and buying AMC shares outright. They know the game is changing and they're scrambling to adapt. When reverse repo finally hits zero, and it's headed there, it doesn't mean AMC will squeeze instantly overnight, but it does start the countdown. Without easy money to sustain their positions, shorts will eventually hit a wall. And when that happens, their only options are to cover, close out, or face margin calls. But liquidity isn't the only problem for shorts. Legal and regulatory pressures are also building. We've seen lawsuits against naked short selling, we've seen U.S. courts ordering reviews of SEC rules around stock lending, and we've seen regulators starting to question the risks created by swaps and overleveraged positions. Each of these developments points to one thing. The old tricks that shorts relied on are coming under scrutiny, and the safety nets are starting to disappear. Take the example of Morgan Stanley. They were fined for failing to report open interest in multiple instances. Now, the fine itself, $25,000, was basically nothing for a firm of their size. But the real takeaway is why they were hiding that data, to avoid a year's worth of margin calls. Think about that. A major Wall Street institution, sitting on massive resources, was essentially trying to dodge exposure that could have forced margin calls if the truth had been visible. That tells you just how fragile some of these positions really are. And that's just one example. We've seen similar issues in ETFs tied to GME, where swaps were once the backbone of their exposure, but are now being reduced or restructured. Why? Because regulators and market players know these swaps are ticking time bombs. Archegos and Credit Suisse were wake-up calls, but instead of fixing the system, many shorts doubled down, creating even bigger risks. Now those risks are coming back to bite. So when you put it all together, what picture do we get? On the one side, AMC is making more money, strengthening fundamentals, cutting debt, saving millions from expected rate cuts, and benefiting from a thriving box office. On the other side, shorts are watching their liquidity vanish, their tricks get exposed, and their risk levels skyrocket. That imbalance can't last forever. This is why many believe the shorts are on the verge of margin calls. They're boxed in, without cash, without the ability to keep manipulating as freely as before, and with regulators slowly tightening the screws, it's only a matter of time before something breaks. And when it does, all of that suppressed buying pressure could come rushing back. To sum it up, AMC is climbing step by step toward financial strength, while shorts are running out of road. The theater giant that many wrote off as dead money is proving resilient, efficient, and opportunistic. Meanwhile, the short sellers, once so confident, are being cornered by the very market forces they thought they controlled. If you've been following this story, you already know it's been a long battle, but the tide is turning, and the next chapters are shaping up to be explosive. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.